Hello and welcome to Principles of Macroeconomics. This is Module 2.2, and today we'll be discussing inflation, the Consumer Price Index, and how we think about prices in general in the economy. So to start off with, when we think about the Consumer Price Index, or what we call the CPI, what this is measuring is a fixed basket of goods whose prices change year over year. The change in the price of the basket or the cost of the basket is going to reflect inflation. So remember, when we're thinking about a price index, what this is trying to tell us is what's happening with prices overall in the economy. We know that prices of goods and services in the economy, some may rise, some may fall, some may stay the same. But if most prices in the economy are rising, we can say that we have inflation. And a change in an index that gives a general statement about prices allows us to calculate the inflation rate in the economy. So when we look at the Consumer Price Index, what this is capturing is the cost of living of the average consumer in our economy. So let's look at specifically how the Consumer Price Index is calculated. So when we're looking at the CPI, first we need to fix the basket. So here we need to determine what goods make it into the basket. These are going to be goods that are typically consumed by the average household or the average consumer in the economy. The quantity of these goods in the basket remains constant. Next, we need to find the prices of these goods. We determine the prices of each good and we allow the prices to change each year so that we can calculate the change in the cost of the basket from one year to the next. Third, we want to compute the cost of the basket. The cost of each good is going to be the quantity of each good that's in the basket multiplied by the price of each good. Remember that the quantity is going to stay constant, whereas the price is going to change each year. So therefore, since the quantity stays constant but the price changes, that means that the cost is going to change year over year. So once we have the basket's cost and we add up the cost of each good that's in the basket, we can then calculate the CPI. So the CPI is going to be the cost of the basket in the current year divided by the cost of the basket in the base year. Lastly, if we want to compute the inflation rate, we simply take the percentage change of the CPI. We take the CPI this year minus the CPI from last year divided by the CPI from last year times 100%. And that's going to give us the percentage change in the price index from one year to the next, and that's going to reflect the inflation rate in the economy. So let's test our understanding. Here you can pause the video and you can try to take a crack at this example by yourself and then come back to look at the explanation and the analysis with me. So in this example, let's consider an economy where the typical consumer is going to be consuming 10 pounds of beef and 20 pounds of chicken. These are the two goods in our CPI basket. Here in this table, we can see the price of beef each year and the price of chicken each year. Right off the bat, you can see the prices of beef are rising and the prices of chicken are rising. So both of these products are becoming more expensive. We want to know, what is this telling us in terms of the CPI, and what is our inflation going to be from 2011 to 2012? So let's do the calculations. To start off with, we know that the quantities are staying constant. So we want to calculate the cost of the basket. So we take the price each year that changes, multiplied by the quantity that stays constant, and the cost of the basket is going to be the sum of the cost of beef and the cost of chicken. So price times quantity for beef plus price times quantity for chicken. And when we add up these columns, that's going to give us the cost of the basket. So we add up these costs and we see that the cost of the basket in 2011 is 120, in 2012 it's 150, and in 2013 it's 210. Now remember, the quantity is constant and the only thing that's changing is the price. So the cost of the basket becomes more expensive because the prices of each good are rising. So now let's try to calculate the CPI. Remember, the CPI is going to be the cost of the basket divided by the cost of the basket in the base year. Remember back to our example, we were saying that the base year is going to be 2011. Okay, so if the base year is 2011 in the index, we're going to have for 2011 120 divided by 120 times 100, and that gives us a CPI of 100. For 2012, we're going to have the cost of the basket in 2012, 150, divided by the cost of the basket in the base year, 120 times 100, and that gives us a CPI of 125. In 2013, we take the cost of the basket in 2013, 210, divided by the cost of the basket in the base year, 2011, which is 120, times 100, and that gives us a CPI of 175. Now we can calculate the inflation based on the percentage changes in the CPI. We can see that here, the change from 2011 to 2012 is going to be a rise in prices of 25%. And from 2012 to 2013, we see that the rise in prices is 40%. So what is in the basket? So we know that each country calculates the price index based on what the typical consumer is consuming. As you can see here, this is the CPI, what's in the CPI basket for the United States. So here we see that the biggest chunk is going to be made up of housing. So the biggest expense for the typical household is going to be spending on housing. Next, we have food and beverages, as well as things such as transportation, medical costs, recreation, education, and other goods and services. So the combination of all of these categories makes up the CPI basket for the United States. There are a couple of problems with how we calculate the CPI index and what it tells us about inflation. There are three specific issues. The first is what we call the substitution bias. Now we know when a good becomes more expensive, what that tells us is that some people are going to substitute their consumption of that good for something that's a little bit cheaper. But the CPI keeps the quantity of the good constant. So in fact, because the quantity stays constant and doesn't reflect the substitution that people do when one good becomes more expensive, the CPI might overstate the inflation in the economy. Next, unmeasured quality changes. When a good becomes better quality, it's difficult to necessarily put a price tag on that. So for example, if an iPhone 5 is obviously better than an iPhone 6, but if both of them costed $600 the year that they were issued, we're not necessarily able to calculate and account for these better quality, the better quality iPhone in the iPhone 6. And lastly, the introduction of new goods. Because new goods reflect better and more variety for the consumer, that tells us that the consumer is better off. We're not able to calculate and necessarily account for these new goods immediately in the CPI. It takes some time for the government to revise what is in the CPI basket to take into account these new goods. So specifically here, we can think of when people used to use typewriters versus computers. As personal computers became more popular and typewriters became less and less popular, it took a little bit of time for personal computers to be considered part of the CPI basket. Now, we also have some costs that are associated with inflation, such as menu costs, shoe leather costs, and the drop in purchasing power. Menu costs reflect exactly the cost for a business to change their prices. So here you can think of an example of a diner that has a huge menu and many, many different food items that they're offering. If inflation is rampant and prices are changing very quickly in an economy, then that diner has to change its menu, let's say every week or once a month. Now, we've all seen how huge those menus are, and you can think of how expensive it would be for a business, such as a diner, to change those prices every week or every month. It gets quite expensive. Next, shoe leather costs are going to reflect the costs associated with trying to counteract inflation. So here, specifically, it's thinking about changing your assets and going to the bank more frequently when there's high inflation in an economy. And lastly, the drop in purchasing power. Because you need more money in your pocket, in your wallet, to buy the same amount of goods and services in an economy, when there's high inflation, each dollar that you have in your wallet becomes less valuable. So your purchasing power with each dollar falls. So there are obviously some problems with calculating the CPI, and there are some costs associated with inflation. But overall, we can say that the CPI is a good measure to allow us to understand what's happening with prices in general in the economy. And it's a good way for us to be able to calculate inflation from one year to the next. Thanks so much for joining me in Module 2.2 on the CPI and inflation.